Unrivaled Nation, Kava stock, CAVA, has the markings of being a potential multi-bagger over time, the type of stock that can go up hundreds or even thousands of percent. And yet, the stock has gotten pummeled so far this year, causing investors to wonder, how much further lower could it go? Where's the bottom? What are my thoughts on the valuation? Why has the stock gotten hurt? What do they even do? We're going to cover all that and more in this video talking about Kava. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment content, I do appreciate you hitting that thumbs up, hit that subscribe button. So as I just mentioned, Kava stock pummeled so far in 2025, down around 30%, whereas the US indices around flat year to date. So that clearly is a difference where investors are saying, yeah, I'm not happy here with Kava. You get a little indigestion. Looking at the results, you can see actually nothing here to cause indigestion. You can see 28% revenue growth. Store traffic is very favorable at 7.5% growth year over year. Same restaurant sales growth of around 11%. So that means just their stores that have been open, for let's say 20, this does not give them any credit for the new stores. So it's an existing store base. They're growing without any credit for any new stores opened. They're still growing the business at 11%. So that is quite remarkable because you can see their total revenue was 28%. The same restaurant sales, getting no benefit from new openings, was closer to 11%. So either way, this is a growing business. It has attractive profit margins around 25%. There's a lot of restaurants that are nowhere near that. That's the restaurant level profitability. That's not consolidated, but on a per restaurant level, that's still quite attractive. They're self-financing, so positive free cash flow. That's a big development because when you're positive free cash flow, it means you can self-finance your hyper growth. That means as a shareholder, you get to keep your piece of the pie. If you have a company that has hyper dilution each year issuing a ton of stock, your piece of the pie gets smaller. So I like to see that positive free cash flow. I like to see net income exploding. That means they're managing their costs. This is, a lot of these developments look quite good. And so you might be wondering, well, what even is Kava? The way to think about it, or the way they describe them, is right here, which is a category-defining Mediterranean fast casual restaurant brand, bringing together healthful food, so it's supposed to be healthy-ish, healthful, and bold, satisfying flavors at scale. I've gone to Kava a few times myself, and personally, I find the flavors to be pretty good and reasonable. It's, there might be a hole in the wall falafel place that I prefer to, check out, but this is still quite good. I would say generally I've had favorable experiences going to Kava, trying their different food options. But I think and by the way, as I already mentioned, this is a company generating attractive profit margins, 25%, in the most recent quarter on a per restaurant level. So that doesn't factor in, the new restaurants or the costs of opening new restaurants, I should say. And then what really I think is the growth thesis, and I'll make myself disappear for a second, is this looking at this restaurant count. So not only have they proven the business model with that, 25% ballpark restaurant margin level, but the fact is that this store count, this restaurant count, is sub 400. So this, whenever you think about a fast service type of restaurant business, fast casual, just based on, I have a book of Ray Kroc's biography of McDonald's over my shoulder, grinding it out, highly recommend. And, from that example that there's potentially thousands of locations over time if the concept succeeds throughout the United States. And then you look at this chart and you go, oh, under 400. So 1,000 plus potential, under 400, plus you get some growth, plus you get pricing power, plus inflation over time. That's the formula for multi-baggers. When you have that growth, you have that profitability, you have that self-financing, those are the ingredients for a potential multi-bagger. So it gets me excited. I want to dig further in terms of understanding the setup, especially, seeing that the stock's down 30%. Then you see management's guidance for fiscal 2025. They've upped their guidance. From the fourth quarter of last year to the first quarter of this year, they're saying, yeah, we're going to open up more stores. So they're bumping up the number of new stores they're going to open. They're keeping their same restaurant store sales growth effectively the same at 6 to 8%, roughly the same profit margin per store, around 25%. you're still going to see, a little uptick in pre-opening costs because they're opening more stores, and talking about, strong EBITDA, raising the ceiling for what their EBITDA could be for this year. Once again, these are data points that I'd like to see. And yet, why is Kava stock down 30% if their results look good? It's a tasty financial picture, clear opportunity. What's going on? So I think there's a couple of things. One is concerns over tariffs. You've seen articles, this one's from Barron's, talking about restaurants will be an early tariff victim, what could limit the pain. And then you even see Greek feta producers, and keep in mind, feta is definitely an ingredient that you're going to have if you like your cheese with your Mediterranean food of Kava. There's some concerns. Oh my goodness, there might be some U.S. tariffs on Greek feta, therefore input costs for Kava could go higher. So that is a risk. I think another real concern is the consumer. And you may have gotten a taste of it during the first quarter, maybe a little, which is that their same restaurant sales went from 20% year over year growth to closer to 11%. 11% is still really good, as I already called out. And I already explained, these are the restaurants that have been open for a while. So this is still really good, but it is a deceleration. It's a significant deceleration. So it does get investors worried. Oh, and you're guiding to like 6 to 8%. Does that mean there's further deceleration to go? Does that mean potentially a weaker consumer? I don't think quite yet that you really have to worry about the weaker consumer. That said, that's a macro assumption, and macro is inherently volatile. I mean, just earlier today, I think the Federal Reserve, the Atlanta Fed branch of the Federal Reserve, posted their GDP forecast, saying that the economists are now expecting effectively a surge in GDP growth from a contraction in the first quarter to now 4% ballpark growth in the second quarter. So that would suggest consumers are going to have some money to order a little extra feta on their falafel when they go to Kava. But I think the real key reason why Kava has come under pressure is the reasons I just mentioned. That's more sort of headline concerns. I think this is the heart of it, which is that every stock is driven by three variables. It's the free cash flow that can go to you as a shareholder. Right now, the majority of their free cash flow is going to opening up new stores. That makes sense because they're seeing an attractive return on that. So then the next is, can you drive fundamental growth? And yeah, they're posting 30% revenue growth. So you got that. Then the third piece, so we got cash flow to shareholders, fundamental growth. That third piece would be, valuation. And over a multi-decade period, valuation tends to wash out. But for the last year or so, and year to date, that's come under real pressure because Kava previously was trading around 20 times sales. Now it's trading around 9 times sales. The reality is, with investing, it's important to have the mindset of base rates, meaning companies that are in this type of situation, how do they perform? And the reality is the base rates for companies, that it's a statistical term, base rates, thinking about, how often do companies in this type of situation, what's the general framework for how they perform? Just like SPACs generally don't perform that well as a base rate. Generally, it's actually negative. So as a base rate for a company at 20 times sales, generally, I don't have the exact figure in front of me, but I know you're dealing with, this is very rarefied air. It's very expensive valuation when you're talking about 20 times sales. You need to just have amazing execution, and any sort of headline risks can't happen. You can't have, the tariffs concerns, consumer slowdown concerns. You can't have that at 20 times because it's just such a lofty valuation that needs to get filled. So that's the key part of why Kava stock has lost about 30% of its value so far this year in 2025, is because of that valuation compression. So then the next question is, okay, so there's been this valuation compression. Where does it go from here? I mean, is 9 times still expensive given their growth and profitability? Well, first of all, none of this is financial advice. I don't own a stake in Kava. I'm just sharing my personal take on it. Also, quick plug, earlier this week, Kieran D, a member of the Unrivaled Investing community, he shared the following. He said, gave this service a try and was very impressed. Been investing for 5 years now and haven't found anything comparable to what you're providing. This follows Doug S, another premium member, saying, I've been a member only 3 months and I am overwhelmed by how good your service is. Your average costs on some of the top holdings are several times lower than the current price. If you two are looking for compelling ideas, come check out Unrivaled Investing. By the way, at the end of this month, prices are going up, particularly for the premium tier. here. So now is the time to lock in that rate. Only a couple days remaining. Thinking about Kava, the opportunity set. What's going on with Kava? Because it's not only the profitability, but what's that runway for growth? Management making very clear, look, we have this huge runway. We think we can do 1,000 stores by ballpark 2032. Some people even think that's conservative. Some people think they can even be closer to 2,000 stores by that date. And so that would drive strong growth. And management, even very recently, talking about doubling down on their expansion plans. I think it is worth understanding. Yes, you can have strong growth, but it's important that you understand that valuation, as we were just talking about. And you can check out Flash, see the link below, completely powered by AI. The reports are free. And by the way, now for the month of June, what we're going to do is allow users to request company reports for free. So that way you can try it out. And that way you can see, wow, AI has gotten really powerful and can help you on your investment journey. So I call this out because we ran a report on Kava, and this was in March, and it effectively said, literally, this is what actually, let me not, paraphrase. Let me give you exactly. Kava is a high growth concept category leader with a long expansion runway and improving profitability, making an attractive growth investment. But much of that promise is already reflected in the share price, demanding careful monitoring of execution against expectations. And it talked about how the estimated share price over the next few years might only be around $76, suggesting further downside from here for Kava stocks. So I think that is important to recognize. Now, you may disagree or say AI is not, good enough quite yet, but I feel like this tool being free to use, where you can look up any company you're interested in around the world or create reports for any company around the world for free to you. Once again, see the link below. I think that's a powerful tool for investors to make sure, hey, I don't get over my skis, or at least I'm aware of the risk when I'm considering any company. And you might say Kava is amazing, but if you have AI saying, look, this is AI's most rational take on, this company, might be wrong. You need to do your own analysis, but I think that is a helpful perspective for investors to consider. So once again, check out Flash, see the link below. Once again, free to use in terms of, pulling, reports and seeing the reports that have already been posted. So thinking about the hypothetical valuation framework, because the stock price is currently around $80. Yes, they've posted incredible growth. And yes, they're growing around 30% this year. And yes, their profit margins might be around, let's say, 20% long term. In that case, assuming continued strong growth, let's say ballpark 20% and a 30 times earnings multiple 5 years from now, the challenge is you're still not getting a crazy return over the next 5 years. Less than 100% upside ballpark and maybe 40% downside ballpark in this, this framework. Once again, this is hypothetical stock price higher or lower, depending on execution. Does management deliver on this framework, or does something is there some sort of exogenous shock that causes things to go way worse? You could also have an exogenous shock that, gets things a lot better. I mean, maybe you have humanoid robots and, it's Kava, you have the robot serving you, you have Wally making your falafels, then you'd probably have an even higher margin profile. So, I mean, that is worthwhile to reflect when you're thinking about the reality or the possibility of different outcomes. So I look at this current price and I'm thinking to myself, it is definitely possible that you still see further downside from here, just based on this framework. This is not a framework that is compelling enough to get let's say a disciplined growth at a reasonable price, or disciplined value investor like myself to get involved. I consider myself, I try to be disciplined, straddling both growth and value. I'll consider either. And so this is not yet at that valuation where it hits me over the head and I can say, oh, in my low side, I can pencil out 50% type of upside. And that's personally what I look for when I'm adding capital, is when I say, oh, in the low case, I can still sort of get that. That would probably require a price, around the 40s. I'm not even, sure that I fully buy into, let's say, a 25 times 5-year multiple, 5 years out earnings multiple. That might even, be high, but it really just depends on how certain are you that this store rollout could be, thousands over time versus the 1,000. Either way, I still view this as, it's interesting. I love to see companies that are profitable, self-financing, where the Founders are still, have a role with the company, obvious growth potential. So it does check some of the boxes that I'm looking for, but in terms of that compelling valuation, it's just not quite there yet. If you have a different take, I'd absolutely love to hear it in the comments below. Thanks so much for watching Unrivaled Investing.